So we just got the latest data from the TRREB with regards to the GTA housing market, and according to them, the housing market has slowed down by 50% compared to last year this time around. Plus, if we combine the jobs number that we got published from last week, according to that, we have seen the unemployment has dropped down to the 5%, which has been a record recently. This will push Bank of Canada to consider another rate hike in the next meeting coming up this month on January 25th. Plus, what's happening in the Canadian economy, how resilient the economy has been after what we have seen, the most aggressive rate hikes in the history. So we are going to talk about all of this in this video, so stay tuned till the end. Let's go. All right, welcome back. My name is Yasin Nizami, and I make these videos to educate my audience about the real estate market in Canada, particularly in the GTA, as well as some macroeconomic factors, some investing strategies. So if you are interested in any of these topics, consider subscribe, and let's get back to our topic of the day. Now, we just got the latest data from TRREB, which is Toronto Real Estate Board. And according to that, we have seen the number of sales, the volume has gone down almost 50% compared to last year this time around. And if you look at the average price year over year, that is gone down by 9.2%, although we have seen a consistent month over month decrease in the last 9 months since the February peak. And if you look at the total listing, because the volume has gone down significantly, that means the listing must have been low as well. So this is exactly what we are seeing. The listing has dropped 21% compared to last year. Now, if we look at the days on the market, because the market has slowed down, the rate hikes have removed all the investor buyers from the market. So the only type of buyers in the market right now are the ones who are looking to buy for themselves. So as a result of that, the days on the market has gone bigger compared to last year. So we have seen 110% increase in the days on the market compared to last year. Now, if you look at the condominium statistics, we can see a similar reduction in the sales volume, almost 47% drop compared to last year, but the price have gone up compared to last year. So in the condo market, we are seeing a rise or more stable price appreciation, purely because the condo market has been affordable for a lot of buyers who are looking to still buy for their own shelter. So you can see the average price right now in the GTA is somewhere close to $720,000, which is somewhat affordable to many of the buyers in the market. Now, if you look at the listings data, so we can see there is a reduction in 16% compared to last year. And the days on the market has gone up as well in the condo segment, purely because the buyers are still, taking more time to shop around and then, buy what's available, because we don't have enough inventory and more options for buyers to compare and then choose from. Now, if you look at the rental statistics, we can see the rental applications have also gone down to 17%. Now, one logical explanation for that sales volume reduction in the rental segment is because if the buyers are not buying right now, so they might be staying in their current rental place, which means there's less inventory of rental units available in the market, which is of course pushing the rental price up, and which is what we can see here. The average one bedroom apartment rent has gone up by 20% compared to last year. A massive increase in the rent prices across GTA as well as in other parts of the country as well. And this is what we are seeing on the ground level as well. Now, a lot of realtors and experts are kind of predicting that 2023 is going to be a tough year for real estate market, because the rate hikes has not helped the buyers at all. You see the current mortgage rates, they are almost above 5% and between 6%, and some banks are actually offering over 6% rate. So when you're going to be tested and qualified at a stress less of 7+%, that qualification criteria is going to be very difficult for buyers to be qualified. So that will remove a lot of would-be buyers from the pool, which will of course push more downward pressure on the pricing side as well. The interest rate is not the only thing that is going to impact the pricing, because there are many cross currents in the economy. So one factor is definitely the interest rate, which is not helping at all. But then we have the influx of immigrants. I know that the immigrants won't buy the property straight away, but they will certainly put the pressure on the rental side. So the investors category who has been buying condos will likely to get benefit from that influx of high amount of immigrants, which will drive the rental market consistently up in this year. If you look at the economy, we got the numbers last week from Stats Canada, and funny enough, the market were expecting 5,000 jobs, but then we saw in the north of 100,000 jobs being published. Now, certainly the math doesn't work here, right? So at the same time, US also published their job numbers, and their job numbers were, of course, twice as much as high as us, but then their population is 10 times more than Canada. So certainly there is something wrong in the way the Stats Canada is calculating the jobs number, but this will push Bank of Canada to rethink about the interest rate strategy, because if the unemployment is historic low, which is 5%, which means the Bank of Canada will likely to consider another rate hike coming up this month on January 25th, which a lot of economists are thinking or predicting that this is going to be another 25 basis point rate hike this month. Having said that, we saw the unemployment has gone down significantly lower, but then when we look at the total work hours, they have not gone up significantly, which means the productivity hasn't been improved across the board. Yes, we have unemployment low. That means most likely one person is doing 2 or 3 jobs, which doesn't increase the productivity in the economy. So when you look at from a pure GDP perspective, there is not a lot of productivity being increased in the economy, which is not a good sign from an economic growth perspective. Yes, the unemployment is low, but then I think we have to look under the hood what's driving that unemployment number going forward. So one of the fear we had was the higher interest is going to basically fire up the insolvencies in the business segment. And what we have seen right now is the consumer insolvencies is up 16% in November compared to the same month the year prior. So what we are seeing here is the industries that saw the biggest increase in the insolvencies are mostly accommodation, food services, and construction, while mining, oil and gas, and finance and insurance saw the biggest drop in the insolvency. Now, the key point here is if the construction industry is seeing a high amount of insolvencies, that is not a good sign for real estate market, because if the construction industry is going out of business because of rollover debt at a higher interest rate or something else, that is going to remove the labor pool, which is already too short, from the industry that is needed the most in order to build more houses in the country. It's not a good sign, but this will put a lot of pressure with regards to building new homes in the country. So the whole supply narrative will come up again, because if we don't have enough people to build the houses, we have labor shortage. And mind you, a lot of boomers who are retiring from the real estate or construction industries, we don't have a lot of young people coming into this industry, which is going to be a challenge from future perspective. So that's it from me this week. I think the 2023 is going to be a tough year again for the real estate market. We'll have to see how the rate hike is going to settle. My previous thesis was I think Bank of Canada would pause, but I think looking at the job numbers, this may push them to make another rate hike this month, and maybe they will pause after that. Again, we have to look at the data, because the inflation is still too high from their target. But when we look at the last 5 months of month-over-month CPI data, that shows the inflation is kind of coming down. And if we see the consistent trend like this, which means the inflation will come down very, very quickly within the range of what Bank of Canada is targeting for, which is between 2 and 3%. Anyway, time will tell. I'm just giving you my research. You can make your own educated decision about buying or selling. And if you like this video, give me a thumbs up, subscribe, and share with your friends and families. And I'll see you in my next week video. Take care.